Hey everyone, this is Michael, and this is the Stock Picks weekend video for April 9th, 2022. So today I want to do something a little bit different. We're going to go over the current market environment and our current positions and the stocks on our ready and watch list, which are decreasing in number as the market is just not acting well. But I want to really go into a lot more charts of stocks that some of them I'm watching, they're not really on our list, and just show you really what's been going on and the number of failed breakouts and things that are going on. So we're going to get into that, and I'll go into a different platform on my Thinkorswim. So before we start, though, this is our disclaimer, and everything I talk about here is just it's no way should be considered investment advice, and it's all provided for educational, informational purposes only. So we'll kind of go quickly through this part just because we got a lot to do today. So our stock environment is still red, and we moved into an uptrend under pressure environment this week. And we've been losing a lot of stocks, getting stopped out of, which has been the case for quite a long time. I think we've had a lot in a row. But we keep reducing our exposure, reducing our sizes, just to so it's not really hurting us much overall. It's very easy in this kind of market to just find yourself in a huge hole that you've dug down 20-30% or more. So I think we're down maybe 5 from our all-time high. Just trying to manage the risk as best we can by kind of flowing with the market. So we're actually down now to about 15-20% exposure, or even less. It's just been we have a few positions that are starting to work well, and the rest of them have just been stopped out of. We're just seeing very few sectors performing well. It's back to energy, and we're also seeing the healthcare health sectors starting to perform a little bit better. But it's just really tiny pockets that have been doing well. And this is for people that haven't been in this for a long time. This is really not normal stock action. If you've just started and you're getting frustrated, everyone's frustrated. It's really not acting as a healthy market, and it's been this way all throughout 2021, and of course this year too. So in a normal market, the big institutional investors, these are like the banks, the pension funds, mutual funds, endowments, all this stuff, they're out there buying when the market is conducive to making money. So they're buying the breakouts. In fact, when you see a stock break out of a base on huge volume, that's the institutions. That's how you know what they're doing. Occasionally, we'll see, what we saw with meme stocks. All these retail people would come in and they'd have these massive volumes on a breakout. But generally, it's the big funds, the institutional investors, and you'll see them, especially after the first day. If you can see continued days of a lot of extra high volume, that means that they're adding to positions. So that's in a normal market. What we're seeing lately for the last year is there's really a complete lack of this kind of support. So what's happening, they're actually selling into the rallies. They may have bought the stock at 20 and now it's at 50, and then it breaks out on low volume, which is more the small players in the stock, and then they're selling into it. That's creating a lot of these what you call reverse hammers, or like a wick on the chart. And so it's really the small investors are pushing them up, but without the big buying power of the institutions. Remember, a mutual fund, some of these funds are tens and tens of billions of dollars. And when they have to get a position in the stock, especially a small one, they can push it up, very quickly, just by buying a small amount. So they're all really selling into these rallies. And so that's why these breakouts are failing. And the indexes are really holding up a little better because the institutions are in this kind of difficult environment. They're favoring the large caps and the mega caps. But they're also been out there selling into the rallies of a lot of the former tech leaders. That's why we've seen such really poor performance in a lot of the big winners of the last could be 5-10 years. It's like ServiceNow and PayPal, Square, Atlassian, HubSpot. I could go on the Trade Desk. These are companies that made a huge moves, and now they're being hit by a lot of selling. And some of the worst ones like Zoom and Teladoc, the ones like Kathy Wood from the ARK funds, has been just continuing buying. I mean, some of these were down a huge amount. And of course, there was a huge bounce starting a couple weeks ago when the market went back to an uptrend. but now we're starting to see more selling come in. So what do I do? Well, we're going to get into a lot more charts, but I wanted to do just a little quick run through of what's been going on. So over the last couple of years, so we had in the big tech bull market, when the coronavirus crash happened, the Fed pumped in trillions of dollars, and against everyone's expectations, the world is shut down. Those videos you see, you can walk through Paris and Rome, and there's nobody on the streets. Nothing, business is shut down, and the stock market just goes crazy. So and especially the tech sector just took off. We had all these stocks go up hundreds of percent, in some cases 1,000% off its lows. I mean, just crazy stuff. So, but then what happened in late 2020, we started the transition out of these high-priced growth stocks and into more cyclical names. And it started out pretty quietly. Then when 2021 rolled around, we really started a cyclical bull market. And cyclicals are really just more value stocks, energy, agriculture, steel, chemicals. These really started to take off. And the tech stocks really started to just slowly grow. And in other videos, I've showed like the advanced decline line, or the percentage of stocks above the 200-day moving average for the NASDAQ. At one point in late 2021, it was at 18%. It means that 82% of stocks were below, which means that 82% of the stocks were basically in bear markets, which in the NASDAQ, which is just a huge number. Normally the whole market would have crashed, but it got propped up a bit by some of the mega caps, which they keep piling into. And again, there's a handful of stocks that make up almost a quarter to 30% of the indexes nowadays, because we have now trillion-dollar companies. So that's kind of made the indexes not really applicable to what most stocks were doing. And then we get in today, we have now the cyclical bull market is continuing, and we're really getting, because of rising interest rates and what's happening in the Ukraine and Russia, the oil and gas is just continuing to be really the strongest sector. So here's just a chart I haven't shown before, and this kind of value versus growth. You have the Vanguard Value ETF, that's the green line, and this chart's going back to 2000, so over 20 years. And then we have the blue line, which is the growth ETF. And for basically, I think almost since the 1982 bull market started, it's almost consistently been growth is the place to be, value has been not. And we crossed over in 2020, and it's something we haven't seen in a long time. Now we kind of come back to a meeting ground here, but I expect we might just see that value now is going to be sort of the place to go, and growth is not. So that's a big change for the market. But it's when this transition period, what we're seeing, has made it very difficult, because also investors go, oh, I made all this money, or they have all these quote unquote sexy stocks that are the high flyers, that, oh yeah, this is a place to be. And so everyone wants to go back into, these stocks, but they may be broke. Well, a lot of them are broken. They can take months to come back, if they ever do. And that's not the place to be anymore. It's really now more, even utilities are doing well. Those are all defensive names that normally, Philip Morris comes in like that. But those are the ones doing well. So it's a different market now. So before I get into the charts, one last thing I want to do is, this is just the top 30 industry groups. Again, you really don't see any growth names here. Chemicals, oil and gas, energy, mining, steel. Here's transportation. The shipping that really got hit on Friday, but oil and gas, mining, you can see it's just used to be filled with software, chips, semiconductors, chips, all those sectors, and you just don't see any of that anymore. So really, the market's really changed dramatically, and it's made it very difficult to make money in the market, because it's not like the switch just changed and okay, we just get into these. They've been volatile also in the transition. Okay, so what I'm going to do is I'm going to come back in a second, and I'm going to bring up some charts and really give you an idea what's going on and why it's been so difficult. So back in a second. Okay, so I brought up my charts here. This is TD Ameritrade's Thinkorswim platform, which is what I use. And I'm going to just show you some of the charts of stocks that some of these were actually on our watch and ready list. But this is just not action we want to see. So this is Triton. I know we had this on our list at one point, but you can see we're getting, this is the kind of action we're seeing. The stock tries to break out. We get these wicks or reverse hammers, and then it plunges. Here you can see we broke out above here, didn't last long, lasted a few days, and then we really broke hard. We're starting to see more and more of this. This is not normal action. Really, these breakouts should just maybe come back to the breakout point. You can see this is where the line is. But this kind of action, sure, you'll see it once in a while in a few stocks, but we're seeing it in a lot of stocks. Here's another one. We kind of just broke out. It just couldn't hold. Then we came back up just repeatedly to that level. Sellers just lurking there. We had another big plunge. So let me see if I can scroll down. You know what? Since I'm doing it on this chart, it's difficult for me to get to my. Let's see, because of the controls. Well, I'll do as best I can here. Because of the way I have to do the video, I'm not getting access to all of the lists that I want. But you can see here, here's another one. We had a breakout over this little base here. Came up, but just came all the way back down, tried to route it again, and failed. Here's another one, Arista. Here it's going back. We had a nice run here. We had a little base, broke out, couldn't hold. Sellers came in. We came up here, broke again. Really, there wasn't a lot of sellers left up here. So this was actually a nice breakout, and then failed. Here's one that's not looking bad. Okay, here's one that was on our watch list. We were watching it here. We're going to try to break it, buy it above this breakout here. Again, most of the selling had already been wiped out around here. We came back up here, and we're holding pretty good, but it just couldn't hold, and it failed. Here's another one. Got back up, couldn't hold. Broadcom. This is one I actually owned and bought it when it broke out here. Now, some of these don't end up on the list because they're just either on our stock pick service, partly because sometimes they're just not set up as well as I would like, or they just I'm trying to always find the best ones for the service. But this is one that I did buy for myself. Also, sometimes they just go so quickly when they break out that there's no time to actually put them on the list. Though we have been doing some buy stop orders occasionally. It's like, hey, we're getting close, put in the buy stop. In fact, there was one, we did the buy stop, it didn't get filled, and luckily because it plunged after that, so that avoided that loss. But again, this was one, broke out, was doing nicely, and just failed, stopped me out. Just very common. Dutch Brothers, another one we've had in our watch list for a while. We had a breakout 2 days in a row and just couldn't hold, failed, would have stopped you out. See if I can, here's a really bad one. JB Hunt had really great news, huge volume, broke out, couldn't hold it, and failed. You can actually see I had a mark here. If it had come down here and was trying to make what's like a pullback buy, in other words, came back down to the top of its previous highs, and it should have just continued up, but really just completely failed, and that didn't work out. Let's see if we can find a couple more. Some of these still look okay. Let's see. Yeah, this is one too we've had on our list. Kind of broke out a little bit. You can see it made a new high, but it wasn't able to hold. But this one's actually looking pretty good. So we're still holding up near this old high. We'd like to see it just kind of tighten up here and just continue to live right around the highs, but without the sellers really pounding it down. And this could be one that's looks like it could be doing pretty well. Unfortunately, I had more. Here's another one, Wave Dancer. We did buy this one, had a nice breakout, and failed. You see the story over and over. I think Aqua was one that we bought, breakout, and it failed. It's coming back again, but again, this shouldn't happen in a good market. These breakouts, when they're set up properly, should just continue up and shouldn't break down all the way down and even go below the 50-day. So it's a tough environment. So that's what we've been seeing. So let me go ahead and pause, and I'll be back with our charts for our actual portfolio picks and ready and watch lists. Okay, so let's start off with Costco. This is on our long-term outperformer portfolio, and this is a stock that is actually doing what it should be. Now, there are some stocks that break out and are acting well, but it's few and far between, and it's almost like random. So the buy spot was right here for part of it. You can see we had a nice cup with handle that formed, and we broke out. This blue area is a buy zone. This is a 5% move, and it broke out and just kind of went up a little bit, came down. This is the 10-day moving average. It just kind of hugged its 10-day, which is fantastic. It's not showing any weakness whatsoever. I think we got in actually here. We didn't get the first move, and we got in this move here. So we're in it. It's doing well. We had a nice breakout on high volume on Thursday. These are the signs you want to see. And also we're looking here, you see a lot more spikes above the 50-day volume average on the blue side than the red. So especially going back a ways. So you can see the institutions are accumulating this more than they're selling. If we go to a weekly, yeah, you can see here we have 1, 2, 3, 4, 5, 6, 7 weeks are up versus 1 down. So that's a great sign. And we're breaking out to new all-time highs. We have a relative strength line that's actually at a nice angle. The stock's doing what it should do. It's broken out, hasn't done anything wrong, and looks really good. So we're in that. We're currently up 7%, which is in this market is really pretty good. Since it's a long-term outperformer, we're going to try to hold it for a longer gain, but we may take a little bit of profits off the table depending on how it acts. But so far, it's acting really well. Let's go to our regular growth portfolio. This is Molina Healthcare, ticker MOH. We bought it, I think, on the 328.92. Let's see. Yeah, we got it right in here when it broke out. It's not doing anything wrong. It's just really not going anywhere yet. It really looks like it's forming a base upon a base. This was a cup with handle, a little sloppy here. But we liked the fact that it had some shakeouts. It broke below to the 50, came back up. Broke below the 50, came back up. The 50 is the red line. Broke below the 50, came back up. Here we came down, just tested it. These are good. This is shaking out anybody who just wasn't really, had a lot of conviction about the stock, which is what you want. Because when you're near new highs, you want to get people that are just like the weak hands, they call them. And then finally, we had a really strong up day, and it got into the buy zone. And it's not doing anything wrong. It's just, of course, we would love it to just take off, but it's not. But it's acting okay. Earnings are still 18 days away, so we're okay with that. We'll just hang on to it. Yeah, that's nothing. It's acting fine. So nothing to do there. The next one is another healthcare one, and this is All Scripts. And this is a little bit of a slower grower, but it's really not doing anything wrong either. We're up currently 2.25%. Bought it at, let's see, 22.26. I don't have our buys on this marked off. I don't have the date either. I think we bought it, either we bought it here. We might have bought it on this breakout day where it just, again, kind of failed, but it didn't fail enough to kick us out. Yeah, I think we did here or here. And so we went a little minus on it for a while, and then it's coming up here. Not doing anything wrong. It's holding above the 10-day and the 21-day. And the relative strength line is heading higher. The only warning here is that we're kind of just wedging our way up, and the volume is decreasing. Not a great sign. Let's look at the weekly. We've had some nice big spikes here on the plus side, on the positive volume. Yeah, it's not doing anything wrong. It's been a little choppy trader over the years. So we sometimes what happens is they get choppy and then they tighten up and then become really nice, just steady gainers. But not doing anything wrong. We're only 2.1% off our all-time highs. So that looks pretty good. The last one is Shell Oil, which we just bought on Friday. Again, we're coming right into this buy area. It just closed a few pennies below our buy price. Now, you notice one thing that we're always trying to look for is when we get up near highs again like this. This is a flat base, but it's almost like a little cup with handle too, which is, we like that because the handle's formed to get rid of the weak holders. So we don't like to see stocks that just come out of a base and then go straight up because it doesn't really shake anyone out. Here we had a little bit of tight trading here where it kind of was right near its old high here, and it came up here and the sellers weren't pushing it immediately down. That's a great sign. And it got just really, not much was going on, tight trading, and then it broke out. And so far, the sellers aren't immediately going, okay, let's kick them out, send them back down. So that's what we like to see. We like to always see these little tight areas where the price is actually contracting. So we have a move down here, then we had a move down here, and then we have an even smaller move here. So this is something that Mark Minervini, one of the all-time top traders, talks about volatility contraction pattern, where you're getting less movement as it gets towards the right side of the base, and then you break out of there. It's he's found that's one of the most important things to see in a stock before you buy it. So I always like to use that exact formula too. So that's our latest buy. Again, this is number 10 industry group out of 197. Of course, in the energy area, that's done pretty well. So let's go through. There isn't much on our other ready list, but let's go through. The first one is Brown and Company. Now, some of these are acting fine. This one's acting fine too. We just had other positions because sometimes people say, well, why aren't you buying all these stocks? Like, what's wrong with this one if you didn't own it? And there's really nothing wrong with it. It's just that we owned other stocks. And since we're limiting our exposure, we just had other positions on and we didn't get this one. And sometimes the ones we buy are the ones that get stopped out and the other ones keep going. It's just, that's the market. If it was a good market, we'd probably own all of them, up to our limit. So this is acting well. Again, you can see that same tight trading right before it broke out. And you can see those contraction patterns. We had a movement down here. This one was almost the same, slightly tighter, but then we had a really nice tight one here. Just came down only a few percent, and then we broke out. Earnings are 16 days. The relative strength line is high. Earnings and sales are strong across the board. We have this also on our long-term outperformer ready list. If you look at the monthly chart, you can see this is what we like to see, a nice steady progression upwards without a lot of volatility. Now, this was the coronavirus crash here, so of course every stock had volatility, but that was right there. But overall, it's been, this area too got a little volatile, but that's because the market has been having some conniptions for this year and a lot of last year. That's this whole base that was forming here. So looks pretty good. So that's on both of our watch lists. That's buyable here, though we of course always like to buy it closer to the bottom of the buy zone, but because your risk is just higher if you're buying it up here. We did add this next one, LPL Financial. Now this is actually, we added it, and of course the next day it broke out. We don't own it, but it looks really good. Now we have this RS blue dot, which shows that the relative strength line is making a new high before the stock was. That's something that many stocks that turn out to be real big leaders had this going on before it started. So that's a really great sign. Again, you notice that we had this tighter trading here in the handle, and it didn't just come up like here. The stock broke out here and just failed. It couldn't stay above there, failed, went all the way down. It came straight back up. Now, sometimes when you see a cup pattern, it just goes straight back up and it just keeps going. We don't like those because it never had a chance to get rid of anybody who's weak, and they tend to fail more often than not. So this one didn't. It paused, formed a little handle, and then broke out. So it looks really good. And another thing, it's pretty decent earnings and sales, but we like over here in the annual earnings. The stock has been in a range for a long time, $5 a share, annual 7, 6, 7, and then 9, nice jump up for this year, and then 14. up 50%. These are analyst estimates, but we like the fact that it's kind of just suddenly it's breaking out to a new level of earnings, which means something is going on at the company on a nice scale. We also like the volume here. This is really great to see, especially the day before the breakout and on the breakout. So this is something, again, if it was a better environment, we would have bought this one, but looks really good. There's nothing wrong with this chart. This company looks good. Let's look at the monthly. Yeah, look at this. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, roughly 18 months up and 3 down. So something is really going on that's good at this company. It's 15 billion market cap, so it's on the large side. Yeah, looks good. So let's move on to the watch list. I know this video is getting kind of long. It's getting close to a half hour. I'll just go quickly through this so we don't break the half-hour mark. Devon Energy, we're looking to buy it when it breaks above this area here. We hope it tightens up a little bit more before it does, but it's a relative of 99, which is the top. So it's really outperforming basically almost all stocks in the market. We do have Shell as the next one, which we just talked about. Granger, I showed you in the other charts. It's come back up here, and we're watching it, and we would try to buy a breakout. But we like what it's doing. It's come back up, pausing here. Volume is continuing to low. The lower the volume, the better. So this one looks good too. Not doing anything wrong. We have another one, KFRC, KFRC, the ticker. This is a little riskier because we're trying to buy it almost in the bottom of the base. We're seeing we have a resistance here around 76, 76.20 or so. So this one we're watching. Ideally, we get a nice big volume spike up above around the 76 area. We would try to buy it maybe here or maybe 75. So we have it at 76.08. So above these, but right below this guy. He's getting a little farther back too. So that's one of our positions we're watching. And then we have ACOM, our last one. This one's not acting as well. The RS now, relative strength is down to 87. It's not doing anything wrong. Again, this is, it's outperforming most stocks. Look, we can go back and let's look at one of the past leaders. So this is what we don't want to see. This is like way off its all-time highs. In fact, we can see they're down 64%, and that's even after the big rally we've had over here. And here we are. Go back to ACOM. The chart looks completely different. So we're kind of struggling, but we're near all-time highs, or at least all-time highs on this one. So we're always trying to find the best stocks, the ones that are holding up the best, and these ones that we have on our lists are some of the best ones. And of course, I'm also adding new ones as they come up. It all changes daily. So that's about it for this week. Of all our picks, I just wanted to give you a little bit more color about what's we're looking for in some of the stocks, especially in this Thinkorswim. It's a different look to the charts, and that's where I put the alerts on. So that's about it. Any questions, feel free to email me. It's Michael at lifetimeinvestor.com. And hope this is helpful, and we'll be back next week. Okay, thanks.